Hello everyone, this is Kevin Zhao, your finance professor at MTSU. In the previous chapter, we covered basics of discounted cash flow valuation. So far, we have learned only deal with single cash flow. In reality, most investments have multiple cash flows. For example, if a company is thinking of opening a new department store, there will be a large cash outlay in the beginning and then cash inflows for many years. In this chapter, we begin to explore how to value such investments. More specifically, in this chapter, we will learn how to compute both future value and the present value of multiple cash flows. And those multiple cash flows could be uneven cash flows or even cash flows. If the even cash flows, we call it as annuity. In addition, we will learn how to compute loan payments or mortgage loan payments and find out the interest rates on a loan mortgage and understand how loans are amortized. And the last topic is to understand how interest rates are quoted in terms of APR or EAR. And here's the outline of the chapter. We have 4 different topics to deal with. First one is to learn how to calculate future value and present values of multiple cash flows. And the second one is evaluating annuities and perpetuities. And the third one is to discuss the effect of compounding periods so that we can understand the relationship between APR and EAR. And the last one is loan types and loan amortization. Now let's take a look at how we can deal with multiple cash flows by using 3 different methods. The first method is time value money formula method. In this case, we apply mathematical formulas to calculate the future value or present value of uneven cash flow or even cash flows. And the second method is to use Texas Instrument BA2 calculator. And here we will learn how to use present value key or future value key to do the calculation, as well as cash flow function on the calculator. And the last one is Excel spreadsheets. Now let's start with a very simple example, and this example involves multiple cash flows. Let's say you think you will be able to deposit $4,000 at the end of each of the next 3 years in a banking account, paying 8% interest. And you currently have $7,000 in the account. The question here is, how much will you have in 3 years? And also you need to answer another question, how much will you have in 4 years? In this question, we have a total of 4 cash flows to deal with. At time 0, we have cash flow of $7,000. That is the current deposit in your banking account. And for year 1, 2, and 3, we will have $4,000 for each year. And here, I highly recommend you to draw a timeline so that you can understand the nature of those cash flows very clearly. And it can help you to determine how many times that you need to compound those cash flows. And the future value of multiple cash flow essentially equal to future value of individual cash flows. And here the calculation show you that we do future value calculation for every individual cash flows. For example, for $7,000 cash flow that occurs in time 0, we need to compound it for 3 times. And for the cash flow that occurs in year 1, which is the $4,000, we need to compound it for twice, and so on and so forth. And for the cash flow that occurs on year 3, we don't need to compound it. And once you get a future value of every individual cash flows, then we add them up to get total future value of this multiple cash flows. To answer the second question, we continue to compound the future value at the end of 30 years and multiply it by 1.8 to get its future value in the fourth year. Now let's take a look at another example. Let's say you deposit $100 in 1 year, $200 in 2 years, and $300 in 3 years. The question here is how much will you have in 3 years at 7% interest? And once again, I want you to draw a timeline so you understand the nature of the cash flow very clearly. And here we have 3 cash flow. At time 0, it's 0. At time 1, that is $100. At time 2, $200. And for the 30 year, that is $300. And here for the first cash flow, we needed to compound it for twice. And for second cash flow, we compound for once, and the last one we did not compound. Once we get a future value for individual cash flows, then we add them up to get future value for these multiple cash flows. And the future value in the 5th year can be calculated based on future value in the 30th year. And we multiply the number with 1.07 raised to the power of 2, which means we compound the future value in the 30th year by twice to get future value in 5th year. Now here's a timeline that you need to draw before you do any calculation. And this is a 5-year time period. At the 0, there's 0 cash flow. And for year 1, 2, and 3, there will be 3 cash flows, which are 100, 200, and 300. And here you needed to count how many times that you needed to compound each cash flow. For the first cash flow, you compound once, twice. For second, you compound once, and for the last one, you do not compound. Right? And in order to calculate the future value in the 5th year, we simply compound the future value at the end of 30 years by twice by using the same interest rate. And this slide shows you how to use Excel spreadsheet to calculate future value for individual cash flows in a multiple cash flow problem. And once you get FV at year 3, then it's pretty convenient for you to fix the FV at year 5 by doing compounding. And here the third example show you how to do future value calculation based on manual method. Invest $500 in mutual fund today and $600 in 1 year. If interest rate is 9%, how much we have in 2 years? And here for first cash flow, which occurs in time 0, you compound it for twice. And for $600, which occurs in 1 year, you compound it for once. Right, once you get future value for each cash flow, so you put them together to get future value for the entire multiple cash flow problem. And here it showed you how to calculate future value in 5 years instead of 4 years. And here the timeline will tell you that, okay, for the cash flow of $500, which occurs today, you need to compound it for 5 times. And for the cash flow occurred in 1 year, you need to compound it for 4 times. Here's more examples of calculating future value. Suppose you plan to deposit $100 into account in 1 year and $300 into account in 3 years. And notice that there's no cash flow occurs in the second year. And here, once again, you need to draw a timeline so you will be very clear about how many times that you need to compound on every cash flow. And the question here is, how much will be in the account in 5 years if interest rate is 8%? So the time framework is 5 years. And on the timeline, you can count, okay, there's 4 years between year 1 and year 5. Therefore, you need to compound it for 4 times. And there's a 2 years difference between the 30th and the 50th year. Therefore, you need to compound that $300 for twice. And for compounding, you use 8% as the interest rate. And here is the timeline of this example. As you see, for the first cash flow, $100, you need to compound 1, 2, 3, 4 times. And for the second cash flow, which occurs in 30, you need to compound for twice. And I think in calculating future value, you need to be very careful in determining the number of times that you need to compound for every cash flows. Now, let's look at the way that we deal with present values of multiple cash flow. Previously, we did future value calculation, and here we switch our focus towards present value. Let's take a look at one example. Let's say we have a multiple cash flows that will give you $200 in year 1, $400 in year 2, $600 in year 3, and $800 in year 4. Let's assume 12% interest rate, and the question is, what is the most you should pay for this multiple cash flows? I mean, here you receive money in the future years, but those monies are not free. You have to pay for that, and the fair value of this multiple cash flow can be calculated through its present value. And for present value calculation, once again, I highly recommend you to draw a timeline so that you understand the nature of cash flow, so you understand how many times that you need to discount for every cash flow. For year 1 cash flow, we need to discount for once. For year 2 cash flow, we discount for twice, so on and so forth. For year 3 and fourth year cash flow, we discount for 3 times and 4 times. And here we use discounting mechanism to get present value. And total present value equals the sum of individual present values of every cash flows. And this slide showed you the timeline of this problem. Right, as you see, it's a 4-year time framework, and here you see very clearly that, okay, for the first cash flow you need to discount for once, for second one twice, third one 3 times, and the fourth one 4 times. Once you discounted those individual cash flows, then you add them up together to get present value of the entire uneven cash flows. Okay, so far so good, and we learned how to calculate both future value and the present value of uneven cash flow by doing manual calculation. And I think many people don't like this method, but here's something that you have to practice for several times when you deal with the homework, and you will see similar questions in the future exams. And other people may prefer use automatic function BA2 calculator, and this approach is not very straightforward. And you have to practice many times in order to understand its operational mechanism. And the mechanism that we are going to use to deal with uneven cash flow on your BA2 calculator is CF function, or cash flow function. To initiate the cash flow function, you need to press the second button on the second row of your calculator, or CF. Once you press CF, it will initiate the CF functionality, and on your calculator screen it will show CF0. But before you do any calculation, I highly recommend you to press second CEC. So what's the purpose of doing second CEC? Well, your calculator may have memory from previous cash flow problem calculation. So in order to erase the previous memory, you needed to do second CEC. So make sure everything is blank on your calculator right now. Okay, Once you do CF, second CC, you will see CF0, right? And it will show as 0.0. Essentially, it asks you what is cash flow at time 0. And then you enter the value for that cash flow, right? And also you will see in the middle of your calculator there is up arrow and down arrow, as well as enter. Every time when you enter a value, you have to press enter to confirm, okay, you are inputting that value into calculator. Now once you finish entering one value, and if you decide to move on to the next cash flow, then you need to press down arrow. Right. Let's say you complete put a value for first cash flow, CF1, let's say $100, and then you press enter, and then move down or down arrow, and then you press down arrow. In this case, you will see F01 on your calculator. What is F01? F01 is frequency of first cash flow. Essentially, your calculator is asking how many times that cash flow will occur in that year. And default setting is 1, and based on the question, that number should be 1. So in most cases, F01 is 1, F02 is 1, F03 is 1, and default setting was 1. So if you are comfortable with default setting, then you do enter and down arrow. Once you press down arrow, it will show CF02, so on and so forth. Now once you complete inputting values for all cash flows, then it's time for you to calculate its present value by pressing MPV. Which is the middle key on the second row, MPV. And MPV is called a net present value, and we will learn net present value in later chapter. But in this case, this MPV is equivalent to present value of uneven cash flow. You might expect to get an answer once you press MPV. However, your calculator will show up I equal. What does I equal mean? Well, your calculator needs more information to complete its calculation. Here, he asks you about interest rate that the calculator needed to apply in discounting those cash flows. So you need to enter the interest rate. When you see I, then press enter and down arrow to display MPV. Right. But still the calculator won't give you answer. You still need to press CPT to send a command to your calculator to do the computing. Once you press CPT, you will see the answer of MPV. That MPV is the present value. Now let's try one example. Let's say we are dealing with an uneven cash flow problem where cash flows are 200, 400, 600, 800 for year 1, 2, 3, and 4. In this case, CF0 is 0. You do 0 enter for C00, and C01 is $200. You enter down arrow. F01 is 1. You enter down arrow. C02 is $400. You enter and then press down arrow. Then for F02, since default setting is 1, you simply do down arrow to go to C03, and then you put 600. Enter down arrow, and it will show C04. You do 800. Enter down arrow, and here, I mean, if you're familiar with the process, each every time when you enter the amount of cash flow, you do enter down arrow. Right? So double down arrow will help you to go through the process of both cash flow and frequency. Once you finish the inputting of cash flow amounts, then it's time for you to calculate MPV. You simply press MPV. Then calculator will show I. Then you put 12. Enter down arrow. It still doesn't show any answer. And the last step is to press CPT or compute to get the answer. This process is not very intuitive, and sometimes if you missed one step, you miss the entire calculation. So I want you to follow this table to do several calculations. And for this example, I want you to get the exact answer that you see here, $1,432.93 on your calculator. All right, and it might take several times for you to practice in order to be familiar with the entire process of CF function on your BA2 calculator. And here's more examples of doing discounting mechanism in finding present value of uneven cash flows. And here we have three cash flows: $1,000, $2,000, and $3,000 in year 1, 2, and 3. And they ask you to calculate the present value of this uneven cash flow given 10% interest rate. As you see, the calculation here is demonstrated as calculating present value of every individual cash flows by applying 10% as the interest rate, right? So here, the key point here is you need to be very clear about how many times do you discount for each every cash flows. Once you get present value for individual cash flows, put them together to get present value for the entire cash flow streams. Now let's take a look at one example. Let's say your broker calls you and tells you that he has this great investment opportunity, and if you invest $100, you will receive $40 in 1 year and $75 in 2 years. If you require a 15% return on this investment, the question is this a good deal or not? Well, the question can be solved by calculating present value of uneven cash flow, which has two cash flows, $40 and $75. Right. So you simply compare the present value with that of $100. If present value is greater than $100, it's a good deal. If it's less than $100, it's a bad deal. Right. And by using the cash flow function calculator, as you see on the right part of this slides, you will get $91.49 present value for the two cash flow series, $40 for first year and $75 for second year. And given 15% discount rate, the present value of that is $91.49. Since you pay more than that, it's not a good deal. Now let's take a look at a problem associated with saving for retirement. Let's say you're offered the opportunity to put some money away for retirement, and you will receive 5 annual payments of $25,000 each beginning in 40 years, which means beyond 40 years you will receive $25,000 for 41 year, and for 42, 43, 44 year you will receive the same amount of cash, money, which is $25,000. So here is the timeline of the problem. So at year 40 you will have 25K, and this 25K will continue for year 41, 42, 43, and 44. There's a total of 5 cash flows. And the problem asks how much money that you needed to deposit today in order to get this future annuity. Future annuity. Annuity means even amount. Even amount of cash flows. Here, the amount of cash flows are the same, right? And we call this as annuity. Right? So to fix this problem, we essentially need to find out the present value of every 25K. Right? $25K. And here's how I deal with this problem. the present value equals 25K divided by 1 plus interest rate of 12% raised power of 40, then plus 25K divided by 1.12 raised power of 41, and so on and so forth. And you will need to add up the value of 5 different items, right? I mean, the amount looks great beyond 40 years, but when you calculate its present value with more than 40 times of discounting, the value will get smaller and smaller, and eventually the answer, I mean, the answer would be a little over $1,000. And also you can use CF function on your calculator to fix that. Since you have 5 equal amount of payments beyond 40 years, your frequency for second cash flow is 5. Right? Your second cash, frequency for second cash flow is 5. And beyond C02, you have C010, CF00, and everything is 0 except C02, $25,000. By the way, although the amount of C010 is 0, but the frequency here is 39 because there are 39 years before the 40th year. Now let's take a look at a quiz question, and this quiz question gives you opportunity to practice the technique that we learned so far in calculating both future value and the present value. We have year 1 cash flow $100, and for year 2 and 3 there will be $200 for each year, and for year 4 and 5 there will be $300 cash flow for each year. Assuming discount rate of 7%, it asks you what is the value of CF at the end of year 5, which is the future value, and also ask you the present value of this cash flow series. Right? What is your answer? Well, let's take a look at the process. Now you can use manual calculation, you can use calculator, or you can use Excel spreadsheet, right? And here essentially you need to know very clearly how many times that you need to discount or compound for every cash flow. Okay, now first look at how to calculate the present value. For the first cash flow, you need to compound, you need to discount for once. For the second, you discount for twice. For third one, you discount for 3 times, so on and so forth. But when you do future value calculation, the number of compounding is very different. For the first cash flow, you compound for 4 times. For second cash flow, you compound for 3 times. For third cash flow, you compound for twice. For fourth one, you compound for once, and for the last cash flow, you do not compound. Right? So be careful. Be careful about number of discounting and the number of compounding. Once you get present value or future value of individual cash flow, then you add them together to get the present value or future value of this uneven cash flows. Right. And this picture showed you the timeline of this quiz question. Right, there are 5 cash flows, and you can either calculate its present value or the future value. But here, I think the most important thing that you need to pay attention to is number of compounding and the number of discounting. And they are very different. For discounting, let's say once, twice, 3 times, 4 times, 5 times, right? When you do discounting. But when you do compounding, that is 4 times for the first one, 3 times for the second one, 2 times for the third one, once for the fourth one, and you do not compound for the fifth one. Any questions? Let's take a break, and we will discuss more about future value and the present value for even cash flow, also called annuity, and also we will discuss the difference between annuity and annuity due. And the last topic for us to to deal with is associated with the loan mortgage.